Good evening and welcome everybody. My name is Martin Stanley and I'm pleased to welcome you to the latest in a series of informative webinars put on by Rowley Turton. Many of you will know Rowley Turton already, but for those of you who don't, we are a firm of chartered financial planners based in Leicester. We've been around for 28 years and we are proudly independent. At Rowley Turton, we emphasise more than anything the benefits of really getting to know our clients and long-term overall financial planning rather than just the mechanics of plans and policies. But in the run-up to the end of the tax year, one thing is always on people's minds. Our minds turn to one thing, which is tax planning. So that's the subject of today. It'll be presented by my colleague Scott, who is a chartered financial planner here at Rowley Turton, and afterwards he will be happy to take questions. There is quite a lot to go through today. So as you will see from the agenda, it'll be a whistle-stop tour on some of the key areas of tax planning that might be appropriate for you. Most of the points Scott's going to cover today will be appropriate for almost everybody. But as well as that, there's a focus on, in particular, tax affecting parents of young children and also high earners, people earning £100,000 and more. In terms of housekeeping, your microphones will automatically be muted and your cameras turned off, so don't worry about that. And after the webinar, we'll be pleased to send everybody who's registered a copy of the slides and also a video of this webinar to watch again. Also, there are a couple of caveats on the next page or two. The obvious thing is that nothing we say today is recommendations as to what you should do individually. It's information for you, and we hope that you might like to discuss it with us or with your own accountant. Before I hand you over to Scott, you'll see on the next slide, this is a picture of a man struggling under the burden of taxation. And you'll see a quote there from Lord Clyde. This is a very, very famous quotation by a judge in court, Lord Clyde. And to paraphrase his very elegant language, what he's basically saying there is that everyone is entitled to take steps, as long as they're honest and legal, to minimise the amount we pay over to the taxman. There is nothing wrong with trying to pay less tax. Scott will now take you through some of the ways in which you might be able to do that. At the end, we'll be taking questions, and you'll see on your Zoom app, there is a place for you to type those in, and we'll look at those a little later. So without further ado, welcome, Scott.
Hello, Martin. Many thanks for the introduction. As Martin says, if you have any questions during the presentation, if you type them into the Q&A box on Zoom, and then obviously we'll deal with them at the end. So first thing primarily about tax is obviously income tax is the main tax that people have to worry about. Most things, first thing to say is that we have a personal allowance of 12,570, which is generally tax-free unless you're a higher earner, and we'll come on to that in a minute. Thereafter, there's a basic rate of income tax, 20% currently. Wait to see what the budget says shortly. That may change. And a high rate of tax at 40% and a 45% tax for people earning over 125,140. There are different tax rates if you have dividend income. For the purposes of simplicity, I've assumed that income in this seminar is just simple earned income or interest. And the same principles apply for what we're talking about today. For dividends, it's just the tax rates are slightly different, and therefore the numbers would be slightly different. But if your earnings are primarily by way of dividend, then obviously just give us a call and we can go through that with you or check it with your accountant, but just to caveat that. One of the things that we particularly notice in dealing with clients is what we call red line income levels. Now, as I say, it's when you go from your personal allowance into your basic rate tax band, people start to notice that, especially if you're on a state pension or something like that. Certainly when you get into high rates of tax, a lot of people will try to keep their earnings below high rates of tax, and also, additional rates. But there's a couple of additional red line taxes which are different to the standard tax rates. So these are twofold. There is the 100,000 to 125,140 effective band, where people are in effectively a 60% tax band or tax rate. That's due to their loss of personal allowance. And I'll come and explain that in a moment, how that kind of works. And equally, if you've got younger children and you are, or certainly previously were entitled to child benefit, there's a higher income child benefit charge for people who earn over 50,000 up to 60,000. It still stays if you earn more than 6,000, but you're fully into that realm, shall we say, after that point. So 6% income tax band. Let's say it's for people who earn more than £100,000. And essentially, for every £2 that they earn over £100,000, they lose £1 of their personal allowance. So the personal allowance can go down from the 12,570 standard allowance all the way down to nil. What that effectively does is put you into a 60% tax band. So that's your 40% normal tax, but then it's the effect of losing the personal allowance on this £1 for every £2 of income you're over the £100,000 figure, and that money then being taxed at 40%. So that £2 affecting £1 of personal allowance, combined with a normal 40% tax, puts you into a 60% tax band. And that's particularly stingy, the fact the taxman is getting, you know, 3/5 of your money, and that's before we mention things like national insurance and stuff like that. The second issue I mentioned is this higher income child benefit tax charge. It was introduced in 2013, although I think it's fair to say a lot of people didn't realise it had been introduced. Like a lot of tax measures, you know, you don't get a letter from the taxman necessarily telling you about this. And for people who were primarily employees who perhaps didn't need to do a tax return before, they've certainly been caught out by this quite a bit. The press picked up on this about a year or so ago. The Times in particular ran a lot of stories that people were getting effectively backdated tax bills, and people were getting £6,000, £8,000, £10,000 tax bills because they hadn't been aware of this tax. So it's important to consider. So it affects those with earnings of over £50,000 and obviously younger children where they're claiming child benefit. It applies to the individual's income rather than joint income. So again, if you have traditional family model where one person earns more, so one person may be earning 60,000 and the one who stay at home looking after the kids, the family income is only 60,000, but the joint income, so the individual's income is 60,000, so over 50, so they're caught. If that income was shared equally, so they both worked and both earned, say, 30,000, they wouldn't be caught by this. And this is one of the unfairnesses, because in a sense, you could have two couples, a couple with both of them earning £50,000 each, and they aren't affected by this, but one person or one wage earner earning £60,000 and they're fully caught by this. It's a very unfair tax. And how it works is that for every £100 that you're over that £50,000 earnings level, you lose 1% of your child benefit. So for simplicity, we'll look at the 60,000 earning level, you lose 100% of your child benefit. The impact of that, if you have one child, because of the combination of the income tax you'll pay on that £10,000 band, shall we say, 50 to 60, and the loss of your child benefit is effectively a 52% tax band. 2 children, it's around about 61%, 3 children, 69%, and it keeps going up. So you have enough children, you can effectively be in 100% tax band. So I've mentioned the key tax bands and these couple of particularly bad, as I would see it, red line tax levels or income levels. So what can you do to address these? These are some of the things we're going to run through today. So pension contributions, charitable gifts, in particular gift aid, alternative remuneration strategies, taking your income in the form of benefits or in different ways, income splitting. I mentioned earlier that if there's a couple where they both earn 30,000 or even 50,000, not affected by the higher income child benefit charge. So again, versus one person earning 60,000, so splitting income can be very beneficial from that. Delaying income in order to push the problem down to future years or for years when you might earn less to avoid these red line income levels. Growth is income, basically just looking at how you structure your investments. I'll cover that. Incorporation, if you're self-employed or partnership, we've got property holdings, maybe an argument for wrapping them in a limited company structure in order to give yourself a greater degree of your control over your income and the tax that you pay. And investments shelters, from the fairly standard, I suppose, ISAs and premium bonds and even investment bonds to the more specialist and high risk EIS, VCTs and SEISs. And I'll explain briefly what those are later. So pension contributions. It's probably not surprising as a financial advisor, we like pension contributions. To be fair, when I first started in the job, pensions were less liked by our clients. I think it's fair to say they kind of pensions had a bad rep. Over that time, they've certainly got cleaner, cheaper and better, and the tax treatment has made them even more attractive. So now generally clients are looking at pension contributions anyway. But the key advantages are you get basic rates tax relief at source generally, depends on how you make your contribution, but generally you're paying in £80, it's becoming £100 with a pension company. If you're a high rate taxpayer or additional tax rate payer, you get more tax relief by way of adjustment in your coding or tax straight back from the revenue. Can be used to avoid the tapering of personal allowances, that red line income of 100,000 and above, and also to avoid incurring the higher income child benefit charge, that's 50,000, to 60,000. You can also do a thing called salary sacrifice if you're an employee, and that's a way of saving national insurance for both you and the employer, and that makes pensions even more tax efficient. From the employer's perspective, the good news is it's not a taxable benefit in kind of the employee, which is both benefit to both the employer and the employee. There's corporation tax relief to the employer/limited company, and doesn't, tax relief is different if you're self-employed or a partnership, and can be used in lieu of bonus or salary to effectively reduce your taxable income. So this is, if you own your own business and you weren't going to take money out of dividend, or salary or bonus, you can basically rejig your remuneration package, as it were, and you can put it through the business as a pension contribution. So again, we'll just run through an example about how pensions may help some people in these red line income levels. So Sam has an income of 60,000 with 2 young children. Like I said, I always mention that 60,000 is particularly bad because at that level, you've lost all of your child benefit effectively, and you can lose it in one or two ways. You can either elect not to receive it and you just don't receive it, or you can elect to receive it, but you can pay a tax charge equivalent to that money. You can argue that both are the same. There are some mechanical differences. Some people, even if they can't receive the child benefit or have to pay the tax on it and therefore effectively get it back, are still wise to register because it leads to things like national insurance credits for non-working parents and things like that. So it's still important to make sure you're claiming it, even though you don't necessarily receive it. So in this particular case, Sam's tax bill is £11,432, and he's lost £2,074 of child benefit. You'll get a copy of the slide so you can run through the calculation yourself, right? The key thing is, in terms of the higher income child benefit charge, is a thing called adjusted net income. And this is where pensions contributions come into play. So if he makes a £10,000 gross contribution, that is effectively a cheque for £8,000 to the pension company for Sam, then, so that's with a tax relief source, then his adjusted net income comes down to £50,000. You run through the tax calculation on a £50,000 adjusted net income, and effectively his tax bill comes down to just under £9,500. So that's a tax saving of just over £4,000 just for making a pension contribution. So essentially, for an £8,000 net contribution, Sam gains a £10,000 gross pension fund, saves nearly £2,000 in high rate tax, keeps over £2,000 in child benefit, equivalent to 60% tax rate. So incredibly great value for Sam, and better money in his pension rather than, I suppose, in the taxpayers, the Chancellor's coffers. Similar thing happens with the 60% band tapered annual allowance. So here we have Rachel. She's a successful business lady. She's total earnings just over 125,000. So she's firmly in that, or she's been caught by that 60% band. Now her total tax, and again, I'll ignore national insurance, just keep things simple, but her total tax is just over 42,500. Again, adjusted net income is the important thing here. So again, if she makes a pension contribution of just over 25,000 gross, which is 20,000 net, that adjusts her net income down to 100,000 for the purposes of this. And how this falls is she takes her out of that 60% band effectively. Her total tax bill falls to just under 32,500. So that's over £10,000 tax saving just by making a pension contribution. So again, she's paid just over 20,000 net into a pension. She's got a pension fund of just over 25,000. As a result, saves just over £10,000 in high rate tax. So essentially, for a net cost of just over £10,000, she's got £25,000 in a pension. So again, 60% tax relief. So these are powerful things that you can do. And as we approach the end of the tax year, your kind of time's running out because the pension contribution has to be made in this tax year. So we've got, literally a month, I suppose, to kind of look at your income, see whether you're in one of these red line income levels, and then to look at whether pension contributions might be appropriate. Charitable donations. So obviously I mentioned pensions, that's a lot of what we do, but charitable donations work in a similar way. By adjusting your net income, so where I use examples of making a pension contribution, Sam or Rachel could have made a charitable donation to achieve the same kind of benefit. The difference then, of course, is that money's then gone to the charity rather than into their pension scheme. But if you're going to make charitable donations anyway, there's a very good tax reason for doing that. Some things to consider. It needs to be gift aid rather than other forms of charitable giving in order for you to get the tax advantages. You want to consider donations generally to be made by the higher earner. So if you're in a couple in that scenario, you want to kind of look at that as a way of doing it. So, because otherwise you just don't get the same tax advantage it is. So you want to work out your income, your partner's income, and where tax lies. And have, if you are making charitable gifts and you are in a couple, then it makes sense to have the person with the worst tax position, shall we say, or to get the most tax advantage to do that. You might want to consider making lifetime gifts rather than bequests through your will. Again, we've done this with some clients welfare that are going to leave bequests for their particular charity in the will, but they might be better to do it during their lifetime. There's an immediate benefit for the charity, i.e. they get the money sooner, and there can be an income tax advantage for the client. And again, finally, you might want to make donations in the same tax year if around the red line income level. So again, you might want to move your donations around in terms of when you make them, if you've got a red line income this year or possibly next year. Alternative remuneration. This is one of the things I like. I've got a picture of Tesla. I actually drive a Tesla because it's extremely tax efficient. I should be on commission from Tesla because I think I've sold about 4 or 5 to my clients following this. The basic principle is you consider foregoing salary, pay rises or bonuses, especially if you own your own business, or it's a limited company, so you have a degree of control of that, and especially if you're around a red line area, and then you basically exchange that for something of equivalent value, company cars, employer pension contributions, etc. I would say with all of these things, you're probably best to check with us and your accountant to make sure you don't fall foul of any anti-avoidance legislation and we do things in the right order. But generally, these things aren't controversial at all. So if we go back to Rachel, who's earning 125,000, she's firmly in that 60% tax band. She shouldn't get a company car. So in that scenario, she might want to kind of look at her earnings position and whether there's something she can do. What she could do, especially if it was her own business, I suppose, she could reduce her salary down by about £12,000 a year and instead have that go towards a car lease. If I looked this morning and you could get a BMW i5, the new BMW fully electric, and the company car tax on electric vehicles is particularly low at the moment, particularly attractive. The lease on that is about £1,000 a month, so to roughly balance out the salary she gives up for the lease cost. The effective cost to the company would be broadly the same, and you'd assume they'd manage it, so there was no cost to the company, it's just providing benefits in a different way. To Rachel in that scenario, she would lose about 400 in net salary because she's in this 60% band, and she'd have a benefit in kind of 50 to 60 or 70 pounds, maybe a bit more on the car, so it's very low. So she would effectively, for a net cost of £450 to £500 a month, be driving around in a car with a list price of about 75,000. So she would be paying less than £6,000 a year to have a £75,000 car through work. And that's incredibly powerful, especially if she was already leasing a car herself personally. She effectively could get a free upgrade, for effectively no money or even a saving in some scenarios. Income splitting is the next thing that people need to look at. I mentioned earlier the unfairness of the higher income child benefit charge, in particular, how it's based on effectively one person's income, not the income as a family. So in a scenario whereby 2 people earn £50,000, each, so 100,000 as a couple with children, they're not caught by this. But if one of them earns £60,000, they're fully caught, and that is obviously particularly unfair. Particularly, you get situations where people move in together and are caught by this in particular. So it might even not be, they might be a step parent, and that again causes issues, to put it mildly. So things that you might want to split, you can split buy-to-let holdings. Complicated if there's mortgages on there, maybe stamp duty, maybe mortgage issues. But if they're owned cleanly and you're married, you're probably fine. If you're unmarried, other issues, and I'll come on to that in a minute. Savings accounts, again, should be putting them into an ISA anyway, but if you can't ISA them and you're married and you're quite happy that, it's our money together, it's not such an issue. Again, investments because of dividend income, and businesses, dividends, salary, maybe you can employ your spouse as long as they're doing a legitimate job, or if self-employed, bring them on as a partner. Again, to effectively, split the ownership or split the income, more importantly. Again, you need to be a bit careful on this and check with your accountant to make sure we're not, crossing the line, but it's fairly mainstream planning, I would argue. You have to be aware of capital gains tax issues if you're passing things like property or share portfolios, to an unmarried spouse in particular. Husband and wife generally fine into spousal exemption. Also about loss of ownership and also divorce risks, because even if you're married, there is an argument about whether assets are marital assets or not, and moving those assets between each other can mean that in the event of divorce, you don't get those assets returned and may end up with effectively losing more on divorce than you might have done. So again, as everything, take professional accountancy and legal advice on these things. But it's very powerful. So we look at a scenario, we've got Hassan, he's a professional landlord, he owns a portfolio of mortgage-free properties generating £60,000 a year of rent, married with 2 young children, his wife does not work. Currently, all of the properties are in Hassan's sole name, so consequently subject to this higher income child benefit tax charge, and also he's a higher rate taxpayer. However, if he splits those properties with the wife, and say the mortgage-free makes it easier, so there should be no stamp duty issues and no issues with the lender, and should be no capital gains tax issues either, then essentially that rent is suddenly £30,000 each, and he benefits from her personal allowance, her basic rate tax band, and avoids incurring the higher income child benefit charge. The maths on that, in very simple terms, is a £6,500 tax saving, by essentially gifting half of the portfolio to his wife. That's equivalent to what, an extra property in terms of rental income each year? Actually net, probably maybe even a bit more. So very valuable. Next option you might want to consider is delaying income. Again, if you're in these red line income levels, you might want to defer your bonus. So if you're on 50,000 a year and you've got children and you've got this and your boss offers you a bonus, well, if it's going to be £10,000 a year bonus, you might be better to kind of stick 2 bonuses in 1 year if you can do that, if you can manipulate your salary just so you keep your higher income level, your child benefit for 1 year. I'd refer that to as a yo-yo strategy, and I'll come on to that in a moment. Again, if you're your own business, you might want to defer dividends. It's your money, you might just want to keep it in your business for a time until it's more tax efficient to take it out. You might want to bring forward or put off work into a different financial year. You have to be careful, obviously, of the HMRC rules regarding this. It can't be work in progress, and again, check carefully with your accountant. But if somebody rings you up and says, "Oh, I want you to do a job for me," and you're self-employed, you might want to look at your earnings position and think, well, do I need to bring that work forward? Fit it in kind of now, or am I better to be, passing on some work, as it were, delaying doing that work till later in the tax year, or to the next tax year. So again, it manipulates my income around these red line income levels. Use fixed term savings accounts, particularly those accounts that pay interest on maturity. So again, if you've got a tax problem now, perhaps you've got children, perhaps you've got savings, perhaps the interest is giving you this problem with your child benefit. Well, you could look at something like a 5-year fixed rate savings account that pays on maturity, in addition to ISAs and premium bonds, which we'll come on to later. And essentially that might take some of this interest that may cause you a problem at the moment in terms of the child benefit and push that out for the next 5 years. So you might have 4 years where you don't have this income problem, maybe 5 if you just do it at the start of a new tax year. So again, there's things you can do. I mentioned there a yo-yo strategy, and this is what I've run through with clients before. So in particular, people affected by higher income child benefit charge, or possibly the personal allowance, right? What you might want to do is you might want to yo-yo your income. So rather than taking 60,000 a year and losing a child benefit every year, you might want to earn 50,000 1 year and 70,000 the next. So again, if you look at this, this is just for examples, standard income, the blue line, 60,000 throughout, yo-yo income, 50,000 1 year, 70 the next. If you do that, there's £1,000 a year effective saving, effectively £2,000 saving in terms of child benefit every other year. But it's incredibly powerful when you think about it that way in terms of benefits to you just for manipulating your income. You've got to do it legitimately. It can't just be falsifying figures, obviously. But if you can shift your working pattern around, work a bit harder one year and a bit less the next, you know, and it's quite feasible. Growth as income and alternative strategy again, which we as individuals are guilty of thinking income is income. It's rent, it's dividends, it's interest. But it doesn't have to be really in that sense in terms of spending money. It doesn't really matter where it comes from. And there's a lot of talk at the moment about tax and people saying, well, hang on, the millionaires are paying less tax because their money is from capital gains. There was a story on Rishi Sunak paying a very low rate of tax because a lot of his wealth or his income, in inverted commas, was through capital gains rather than traditional income. And there's no reason that we can't necessarily take advantage of this. So again, and I was chatting with a client about one of our portfolios, which actually had a very low income yield. And he was concerned about that because, well, okay, what am I going to spend for? Well, we can spend the capital instead. So this is a simplified example, but it works. We have a £200,000 income portfolio and a 5% return in the first year produces £10,000 taxable income. Assume simplicity, it's no growth, it's purely income. We versus that to a £20,000 growth portfolio, again, no income or growth as in this scenario, we can make the same £10,000 return. But one is £10,000 of income, which is taxable if it's not an ISA or something. So if you're a high rate taxpayer and it's interest, that's a £4,000 tax bill. The other is £10,000 gain, but actually, unless we do anything with that gain, if we just leave it there, there's no immediate tax issues, first thing. But even if we need that £10,000 out because we've got to, use that as our spending as income, as it were. If we take a £10,000 withdrawal from a typical growth portfolio, all of that withdrawal is not gain. Only the gain would only be about £500 because most of it would be the original capital we put in. So the tax bill would be much lower by how we structure the breakdown of the investments, as it were. I mentioned some of these earlier. So investment shelters, ISAs, EISs, SEISs, venture capital trusts, premium bonds, investment bonds, and most of these are investment linked, but not all. So capital may be risk and you may get back less than invested. EISs, SEISs, and venture capital trusts are even higher risk. But all of these investment vehicles or products can be used either to give you an immediate tax saving, or to give you to shelter money from tax in the future, normally income tax and sometimes capital gains tax. So what you can do by that is you can reduce your taxable income, not so much this tax year necessarily, albeit with the EISs, SEISs, VCTs and things like that, they can have or do have an immediate benefit from a tax relief at day one. But the other ones, effectively, you're putting your assets out of reach of the taxman in a sense, or certainly delaying when they can take tax off them. And that can be good because, again, if a lot of people are waking up today and suddenly being caught by, particularly on savings and the rising interest rates, a lot of people having tax issues that they didn't before. So we've had very low interest rates for a very long time. So somebody with, I don't know, £100,000 in savings, a couple of years ago, you were probably getting £1,000 a year of interest and no tax problems because it would be part of your savings allowance. Now, at 5% return, that's a £5,000 of interest, you're going to have a tax problem. If they'd put £20,000 a year into ISA for the last 5 years, it would all be in ISA, it would all be sheltered, so there'd be no income tax problem. The issue was, of course, cash ISAs in particular, banks tend to pay a better interest rate on non-ISA monies. People might have looked at it and said, oh, there's no point putting it in an ISA, Scott, because I haven't got a tax bill anyway. But you never know how they're going to change the tax rules. Really certain we've been very proactive for a very long time and trying to put as many barriers between you as a client and the taxman as possible, legitimately, just because you never know what the tax rules are around the corner. Incorporation, I mentioned this earlier. Again, rent profits, etc., taxable on a limited company rather than yourself. Again, you need advice, and there can be tax consequences putting money into or assets into a limited company, so you don't want to make your tax position worse. But again, a lot of our clients are using this to defer the tax problem until such a point as their tax position is better or the tax rates are better. Certainly if you don't need the money. So again, dividends are still taxable. So generally the company makes a profit and then it pays that money to you by way of dividends or salary. Now dividends are still taxable, but you have control over whether you to pay a dividend or not, and how much you pay a dividend and when you pay it. And for that, you can, especially if you're around these red line income levels, you can manipulate your income legitimately, in order to save tax. If you're a buy-to-let investor, and we've covered this in a previous webinar, the mortgage interest tax position is horrible if you own those properties directly, generally, and you certainly if you're a high rate taxpayer or would be a high rate taxpayer potentially. If these properties are owned via a limited company, effectively you get full offset for the mortgage interest, so it's much more tax efficient. Again, getting mortgage properties into a limited company is problematic, to put it mildly, and you can create much worse tax problems doing it. But you at least need to consider that option and work whether that would work for you or not. Again, professional advice needed. Limited companies generally allow higher employer pension contributions and personal contributions because they're not limited qualifying earnings. And as I said earlier, they can provide tax efficient benefit in kinds, EV company cars. So one of my clients has a property business. He does a lot of these things. He's got the benefit from the mortgage things. He runs an electric vehicle for the company, and he makes pension contributions, and he can adjust his income accordingly via the business, and it's very tax efficient. Capital gains tax allowance is a big thing that people overlook, really. Now we have a £6,000 annual capital gains tax allowance. It was 12,300. It's been slashed, I would say, and is being slashed further next year to £3,000. Now, again, if you've got an investment portfolio, then when you start to take money out of that investment portfolio, unless it's in ISA or something, then you're going to pay capital or potentially pay capital gains on the profit of the portfolio that you realise. And that's whether that's shares or a buy-to-let property or something like that. And when the allowances were 12,300, that wasn't such an issue because it was fairly generous. But as those allowances are coming down and down, when you actually want to start taking money out of your investment portfolio or selling properties, you're probably going to have a capital gains tax bill where you couldn't. Now, it's harder to take advantage of this with an investment property or even a portfolio of investment properties. But with a share portfolio, what we do for clients often is we look at the current value of your portfolio, what the base cost of that is, so what you paid for those investments. And what we try to do very often is we move assets around, so we sell ABC fund and buy XYZ fund in order to realise gains in the portfolio to utilise your capital gains tax allowance. And that way, you're essentially every year you're rebasing the base cost of that investment and increasing it, so that when you do want money out, you're not got a tax bill. People that don't do that, their portfolios become pregnant with gain, and then when they do want money out, they've got a huge tax bill. The other thing is you can report losses. This is a thing that's overlooked. So if you've done an investment portfolio and you've bought an investment, it's not gone well, a lot of our clients like to do their own little thing on the side, normally little business ventures and things like that. And you'll often speak to them and go, oh, how did that thing go? Oh, it's not so good. Oh, lost 10 grand, 20 grand, whatever it is. Not significant for their wealth, but noticeable. Now, one of the things is that you can report those losses for, I think, effectively for 4 years, within 4 years. And then those losses then can be effectively logged on your account. And then if you make gains in the future, you can offset those gains against that reported loss. But if you don't report the loss, effectively you don't get that benefit. So, and you've got 4 years to do it. So if you had a loss, 3 and a bit years ago, you might want to think about reporting it this year or maybe next year if it's still within the relevant window. And as with a lot of these things, it's a case of use it or lose it, both the allowances and the losses. If you miss either using allowance on annual year, you get another one next year, but you don't get this year's. And again, losses. So if you go past that 4 year window, you lose that ability to use those losses to offset future gains. Inheritance tax, big issue for a lot of our clients. Now, hopefully people know the big numbers, £1 million for married couple, and generally unless your assets are over 2 million, 7-year clock, etc. What people are always a little bit less up to date with or less aware of normally are things like annual allowances, exemptions. So the first thing is everybody has an annual exemption of £3,000 per tax year. And if you didn't do it last year, you can do last year's as well, effectively. So you can do 6,000 this tax year. So married couple or even unmarried couple, 6,000 each, £12,000 if we get moving, before the end of the tax year. So if you've got 2 children, mum and dad can give them 2 cheques for £6,000, £12,000 total, £4,800 tax saving. Assuming you've got an inheritance tax problem, versus not doing anything. And again, you can make the same way. You make a £3,000 cheque on the 6th of April each to get another 12. I'll do the maths now. 2,400 tax saving. Small gifts exemption. Now you can't combine this with a 3,000, so you can't give somebody 3,250. But you can make small gifts up to £250 per person, and that's per recipient rather than you as a donor. And that's essentially tax-free. So if we've got 2 kids, and I know maybe we've got a big family, we've got maybe 10 grandchildren, excessive with 2 children, but some people do have lots of kids. Well, that is then from mum, 10 times 250, so that's 2,500. Same from dads, that's 5,000 we can give away tax-free. Well, maybe these kids are a bit older, maybe they've got partners, maybe we can give them £250 as well. So maybe that's a total of £10,000 for grandma and granddad effectively to gift out. Okay, that's £10,000 off. You say it's a £4,000 tax saving. So that, and the other one is good savings. And the other one which is missed is a thing called normal expenditure out of income. Again, a lot of our clients, as you get a bit older, we spend a bit less. We don't necessarily have less money coming in. If things have gone well, we've got decent pensions, investment income, buy-to-let income, etc. A lot of people find that their inheritance tax situation just gets worse. They've got more money coming in every year than they can spend it. And what the revenue says is where that extra is income, they essentially allow you to do a calculation to say, well, okay, my net income is here, 60,000 for sake of argument. My expenditure is 30,000, so I've got 30,000 a year extra that I'm not spending. And as provided you do it on a regular basis and you can clearly demonstrate it, then that £30,000 excess income, as it were, can be gifted without an inheritance tax bill at all, provided it's done on a regular basis. So what you do is in the next month, you work out your income for this tax year, your expenditure for this tax year, and if there's an excess, you might want to write a cheque to your kids or grandchildren or whoever to say, and the point is to say that this is a regular gift. It's going to be annually. That's the point. But as long as you do one off and you say that it's going to be annually, then you're fine. Obviously, you'd expect to be doing it next year as well, but it's the main principle is about doing it. Again, use it or lose it, really. ISAs, mentioned them earlier. Hopefully, we'll know what those are. Essentially, different allowances depending on the type of ISA. Broadly, £20,000 maximum. You can't do a cash ISA of 20 and the stocks and shares and an innovative finance ISA to do 60. It's 20. We kind of, regardless where you put it, younger people limits are a bit less, 9,000 for junior ISA. Generally, income tax and capital gains tax free, so it can be used to shelter income and gains from future tax, which again is just about getting less income on your tax return, so you save tax moving forward, especially if you're in these red line income areas. Stocks and shares ISA in particular can also be used to save inheritance tax via business relief assets. Bit complicated for today, but you can put investment ISAs by assets that qualify for business relief, and then 2 years later those assets are exempt from inheritance tax, so it can be used to save inheritance tax as well. Again, use it or lose it. We've got a month to the end of the tax year. Better than ISA. So again, not enough people take full advantage of this. We've got an investment portfolio. It's subject to income tax and capital gains tax, and they're given us from. What we basically do is we sell non-ISA assets, so and then reinvest, hopefully utilising capital gains tax allowances as well, and then reinvest that money into your ISA. So I like buckets in my work. So we have a non-ISA investment bucket and then 2 ISA buckets that £20,000 a year that Mr. and Mrs. can use. So we take money out of the non-ISA into Mr's ISA, into Mrs. ISA, and that has the effect of reducing the value of the non-ISA. So we've got less money that's taxed or taxable, should we say, and we've got more money that's tax-free. It's a no-brainer for us. You have to probably make sure you understand the capital gains tax implications of selling assets to do this, but you definitely should be doing it. Pension contributions, I mentioned earlier about how powerful pension contributions are. Essentially, there's an annual allowance up to 60,000, 100% of your earnings, which are lower, but employer contributions don't have the qualifying earnings restriction just to 60,000. Those with really high incomes, kind of 260,000 above, will get a lower allowance, but we can discuss that with anyone who's got that issue. And also the traditional allowance if you've previously taken flexible benefits and hit by what's called the money purchase annual allowance. If you've been affected by that, I would hope that you know about it. Different contribution calculations for defined benefit schemes, and we can chat to people about that if needed. But you can carry forward allowances from the immediate past 3 tax years. And so again, like I say, I like buckets. So we've got the current tax year on the right, then the 3 previous tax years. And how this works is essentially it's like a conveyor belt. So the old generation game, if anyone's old enough to remember that. And essentially the buckets are kind of going on, and essentially they fall off the end of this conveyor belt. So if you do nothing, the bucket at the end falls off and you can't use it. So if you know that allowance is gone, gets replaced by the 24-25 tax year, which is good, but you've lost the 2021 tax year, assuming that you were a member of a pension scheme previously, so you could make use of this. So the idea is you want to make use of that previous 2021 bucket if you've got significant money and you want to make serious pension contributions. And how it works is you have to fill in the current tax year's bucket first, so essentially 60,000 for most people in that scenario. Then you start to make a contribution that would fill in the 2021 bucket, so 40,000 at a time. Then you'd be the tax year after, then the year after. In terms of the contributions, you're all actually made into this tax year, into whatever pension scheme is, but the calculation is that for use of allowances is this tax year first, then 3 years ago, then 2 years ago, and then last year. And if you don't do it's in the right amounts, as it were, you can potentially lose allowances from that perspective. So conclusion, back to Lord Clyde again. This principle, as Martin mentioned, fundamentally it's about that the taxman has all the power in the world through Parliament to essentially put his hand in your pocket and take out what he thinks he's entitled to. But then equally, within the law of the land, and as long as you're not doing anything that breaches the law, you do actually have a lot of power, and morally you're perfectly fine, Lord Clyde argues, to structure your personal tax affairs in such a way that minimises the tax bill, keeps as much in your pocket as possible. Essentially, and that's where we finish. We think you should keep more money in your pocket, as long as you're doing it fairly, shall we say. Fine, 1 second. Let me just put Martin on 1 second, my colleague on. I think you just need to turn your camera back on, Martin.
Okay, well, there's no camera on me, which is a shame, but nevertheless, I hope you're still seeing Scott. Scott, thank you very much for all of that. Just one thing I'd like to add is that we've had a whistle-stop tour through the world of tax planning. Here we are, I'm back. Some of it might seem a bit complex, and some of it is. First thing to say is that we are here to answer any questions you might have on that. Second thing to say is that it's important to realise that complex is one thing, but nothing you've heard today from Scott has anything to do with controversial or aggressive tax planning strategies, the sort of thing the taxman would frown at. Those sort of things do exist, and some of you might have come across them in the wild. If something's too good to be true, it normally is. And if you ever do see something that's too good to be true, let us know and we'll help you navigate that and make sure you know what best thing to do. Before we go on to some questions and answers, I mentioned earlier that Rowley Turton, although we've spoken today just about tax planning, we emphasise long-term planning relationship with the client. It's all about the long-term journey and financial health and welfare, really. Part of that, we have a free book, which we'd like to send you if you'd like a copy, and that explains a little bit about the way we work. So if you're interested, please drop me an email. My email is there on the screen, martin@rowleyturton.com. I'll be happy to send you a book, and who knows, that might start off something in your mind and you might come to see us, which we'd be very happy about. So some questions and answers then. Some of you have sort of sent through some questions, and some of these might be real zingers. Hopefully Scott is up to it. The first one I think is fairly easy for Scott. Is Scott, income tax on interest. Somebody here says that with the interest rates having gone up a lot over the last year, they're now getting more interest on their bank accounts than they were before. But they don't normally fill in a tax return. So if they want to be a good upstanding citizen and pay tax on it, how do they do that?
Oh, it's a great question. You do have to do a tax return, or I think, Martin, which is the form that you have to do to report just taxable income? Is there shortened tax return from memory? Yeah,
what Scott's talking about there is there's something called a shortened tax return which you can enter if you've got tax and dividends and things which you think aren't getting caught up by the taxman. However, if it's just interest on the bank account, which for many people it will be, the quick answer is you don't need to worry about it because the taxman knows how much interest you're getting. Sometimes that surprises people, even frightens people. But if you're getting interest more than that will be taxable, you've used your personal allowance, which Scott explained earlier, perhaps on a state pension, any interest you get, the taxman will know about, and he'll adjust your tax coding in order to take that into account. So it's only if you have a very small, narrow window of tax of income where that won't work. So that shouldn't make any difference. So the answer to that one is that if it's just the income, this is the interest, you don't need to worry about that. Scott, there's another question here, which is, this is from Stephen. I won't give his second name just in case he wouldn't like me to. He says, my wife is a director of our investment business. As an investment business, that's interesting. Is she able to take a pension contribution if she isn't paid a salary? Does it come under the wholly and exclusively ruling?
That's a great question.
And he's clarified that's an employer pension contribution. Thank you, Stephen.
Great question. I think she should be able to. I would want to check with the accountant very carefully. I think it comes down to, is she effectively an employee of the business? And as a director, I would argue that she almost certainly is. There's not a requirement for her to be paid a salary as such. You know, don't know whether minimum wage issues maybe, but I think it'd be fine. I think it should be okay. I'd want to check with the accountant. The wholly exclusively ruling, essentially, for business expenses to qualify for corporation tax relief, they have to be what's called wholly exclusively for the purposes of trade. I've never had an issue with it in the 28 years that Rowley Turton has been trading. I've never seen a client have an issue, and I don't think I've ever spoken to an accountant that's ever seen anyone have an issue with it. But again, I would probably want to run it past your accountant. I think you're probably okay. And again, there's also, I suppose, reasonableness of it. But I think you should be okay. I certainly think you should be looking at it. But I think you'd be all right.
Thank you, Stephen, for that question. And something else to say is that if you'd like to follow that up at all, please let us know, and we can either help you further on that, or we can certainly put you in touch with somebody who can. Scott, another good question here is that he says, if I put my property in my adult child's name, can they pass the income back to me? He says, I don't want to cheat the revenue. I'm not cheating, but I'm effectively using their allowances as well as my own.
I think that would be very great to put it mildly. I think there's a number of issues on there. There would be an issue of whether that was outright tax avoidance, which I fear it might be. The other also, I think that would be a stretch too far, to put it mildly. I would be extremely cautious about that, because essentially, normally you have the other issue actually where people want to gift the property, but they want to retain the income, and they go, well, I'll give the property to the kids, but I'll keep the rent. Bizarrely, you can actually do that, albeit that then effectively means that the gift isn't effective for inheritance tax purposes, but it doesn't give you the income tax issue in the same way, because at least you're declaring it to the person who's receiving it. Yeah, I would put that above and beyond the non-controversial things that I think we've covered today.
Okay, another question here, Scott, which is perhaps not as uncommon as it used to be. This chap, Michael, says, I used to live in Spain and I still have a bank account and some investments over there. If I transfer the money back to my UK bank account, do I have to pay any tax?
Oh, well, you shouldn't. I can't see how you'd pay any tax on moving the money back to the UK. I can't imagine there's any Spanish tax, but obviously you need to check in Spain. Generally, the UK Spanish arrangements are you kind of pay tax, kind of the highest of so a dual taxation route. So generally, you pay the highest tax in the relevant jurisdiction. So you generally pay Spanish tax on Spanish money, and then if the UK tax is any more, you'd have to pay a bit more UK tax. If the Spanish tax was lower than UK tax, so if Spanish tax was higher than UK tax, well, you pay the Spanish tax and you don't pay any extra UK tax, is generally how it works. So I don't see how moving money back how you necessarily incur a tax thing, especially not on cash accounts. Maybe if you're selling if you're selling an asset, maybe there's capital gains tax either in Spain or in the UK. But yeah, I can't imagine just bringing the money over itself would create a tax issue. So we've got another question.
Yeah, we've got another question here. It's got a good one here. This is from Edward. He says, many thanks for the presentation. So that's nice. Thank you for that. Okay, the question, Scott, is if you elect a pension exchange a bonus, normally paid at the end of a UK tax year, i.e. end of March, into a pension contribution, but then due to the paperwork processing by the employer and pension provider, the pension contribution doesn't land into the pension until mid-April, i.e. in the next tax year, does that effectively move some income into a new tax year as it doesn't appear on the P60? as the pension bonus exchange is done by salary sacrifice.
Okay, so salary sacrifice, so provided the salary sacrifice is all done above board, generally I've never had an issue with it, but technically you're supposed to go through a number of steps, so I just err on the side of caution ever so slightly. Yeah, I think there's two things. If you've foregone the bonus in favour of the pension contribution, and we assume that that doesn't create any issues with the revenue in terms of salary sacrifice, generally you're fine, but occasionally they get a bit funny on this, so they keep shouting it as an issue, but I've never seen it actually an issue. Then that income effectively has never been earned, so it isn't really shifted in that sense. It's I suppose this alternative remuneration strategy I mentioned before. So you've gone from having salary or bonus in this case. So effectively you get I suppose the tax advantage of that in the tax year that you gave up the bonus in a sense. So it didn't push you into higher rates of tax or one of these red line income areas. The fact that the pension contribution has been made in another tax year is, from an income perspective, doesn't necessarily matter. It's just whether that would create a problem in terms of your earnings and pension contributions in that year. That would be my concern. But provided that you haven't got a maximum funding issue, it shouldn't create much of an issue, I would have thought. I can't see it's an issue. It's more to do with the pension contribution limits than anything else than the income tax.
Thank you, Scott. And again, Edward, if you'd like any further information on that, if you want to just clarify that, then just give us a call tomorrow or get in touch whenever you'd like. Scott, another question here, and this one made me chuckle because as financial advisors, we've come across this question all the time, not necessarily by dishonest people, but curious people. And the question is from Sid here. It says, if I sell an investment property, buy to let property, I think I need to pay capital gain tax on it. And yes, that's probably right. But the question is, how would the taxman know that I've sold it? How would the taxman know question comes up now and then. So Scott, what's your answer to that, please?
Well, I wouldn't say I've never had the how would they know question. I think it's standard response for everyone to say how would they know. I think historically people did sell properties and didn't necessarily report them. I think the whole buy to let market, I think the revenue is fully aware that not everyone has dotted the I's and crossed the T's in terms of their tax affairs today. They will go through these things. They do effectively check records. Your solicitor, to be honest, shouldn't really kind of let you not pay it in a sense. So the rules on that keep changing. But I think it would get picked up by Land Registry. Obviously, it's not something that non-disclosure is effectively tax evasion, and it's not something we would be party to. But I think you would get found out. In my experience, dodging the tax is not worth it. You hear stories of people who, for years, had two sets of books, and then they send in the correct book, shall we say, and then they get a tax bill, and they go, "Oh shit! It wasn't much deal. I haven't slept for the last 10 years, worrying about the tax man knocking in my door." So I generally view as, yes, there's plenty of legitimate things you can do to structure your tax affairs very tax efficiently, and we all hate paying tax, let's be honest. But there is a certain degree of what you can do and what you can't do. I think most people have got reasonable scope to reduce their tax bills legitimately anyway.
Okay, thank you for that, Scott. Another question here, which is best way to invest money to avoid inheritance tax. A simple question. Is there a simple answer?
Wow. It depends what. The first thing to say is most people don't. Less people have an inheritance tax problem than they think, because the allowances are somewhat generous for the average person, not so much for the wealthy person. If you're really concerned about inheritance tax, first thing to say is what we would do for a planning angle is, do you actually need the money yourself? If you've got more than enough as per a book, then you might want to just pass it down to the next generation for them to invest anyway. If you do have an inheritance tax problem and you want to keep the money and it needs to be accessible, there are a couple of specialist trust arrangements you could use, but generally what you'd be looking at is assets that are exempt from inheritance tax via the business relief exemption. So that's things like business relief schemes, AIM portfolios, things like that. Whereby if you hold those assets for 2 years, they are exempt from inheritance tax. Different risks apply, generally higher risk, but there are ways and means that you can keep the money and invest it and potentially not paying an inheritance tax.
Okay, thank you very much for that. I think that's all the questions we've got at the moment. So It only concludes then for me to say thank you very much everyone for joining us today. Thank you for your questions, and it doesn't finish here, because if you'd like to, then we'd like very much to see you at the office or to hear from you. Please email us or get in touch. If you'd like a copy of the free book that I mentioned about our approach to investment planning and wealth planning, then we'd be very glad to hear from you. So please get in touch. Scott, thank you very much for all the information today. Hopefully it hadn't bamboozled too many people. Last thing is that we'll be sending all of you a copy of the slides and a recording of this, so you can watch it again at your leisure. And we hope to hear from you. Thank you and good night.
Thank you, Martin. Good night.